Question 1. Consider a scenario where an insurance company is developing a predictive model for motor insurance pricing. The model incorporates several covariates, including the driver's age, driving experience, and the average annual mileage. The company is exploring the inclusion of a new time-dependent covariate, the number of traffic violations recorded in the driver's local area over the past 3 years, which is updated annually. The actuary responsible for the model needs to determine the most appropriate method for incorporating this covariate to ensure both predictive accuracy and regulatory compliance within the UK framework. Option A. Model the traffic violation rate as a static covariate, using the most recent available data point for each driver, and integrate it directly into the pricing algorithm without further analysis of its temporal impact. Option B. Exclude the traffic violation rate covariate entirely from the model, citing concerns about its complexity and potential for bias, and rely solely on traditional, static covariates. Option C. Develop a time series model that captures the evolution of the traffic violation rate in each area and assess how this temporal trend, alongside the driver's exposure to it, influences their individual risk profile over time, while also performing an impact assessment for potential discriminatory effects. Option D. Use the historical traffic violation rate as a proxy for driver behavior, assuming that a higher rate directly correlates with higher individual risk, and apply a fixed uplift to premiums for drivers in areas with historically high violation rates, without considering the time-dependent nature of the data. Correct answer is A. Model the traffic violation rate as a static covariate, using the most recent available data point for each driver, and integrate it directly into the pricing algorithm without further analysis of its temporal impact. Explanation. This scenario presents a professional challenge because it requires actuaries to balance the need for accurate risk assessment with the ethical and regulatory imperative to avoid unfair discrimination. The use of time-dependent covariates in predictive analytics can inadvertently perpetuate historical biases if not handled with extreme care. Regulatory frameworks such as those governing insurance in the UK, e.g., FCA and PRA principles, ICO guidance on data protection, emphasize fairness, transparency, and the avoidance of discriminatory outcomes. Actuaries must demonstrate that their models are not only predictive, but also justifiable and compliant with these principles. The correct approach involves explicitly modeling the time-dependent nature of covariates and assessing their impact on risk over time, while simultaneously scrutinizing these covariates for potential discriminatory effects. This aligns with regulatory expectations that insurers understand the drivers of risk and ensure that pricing and underwriting decisions are based on relevant, non-discriminatory factors. Specifically, it requires a proactive approach to identifying and mitigating bias, ensuring that any use of time-dependent factors does not unfairly disadvantage protected groups. This is ethically sound as it promotes fairness and compliance with data protection principles, such as those outlined by the ICO, which mandate lawful and fair processing of personal data. An incorrect approach that focuses solely on predictive accuracy, without considering the ethical implications of time-dependent covariates risks regulatory censure. For instance, if a time-dependent covariate, such as a postcode's historical crime rate, is used without considering its correlation with socioeconomic factors, it could lead to indirect discrimination. This would violate principles of fairness and potentially contravene anti-discrimination legislation. Another incorrect approach, which involves ignoring the time-dependent aspect of a covariate altogether, would lead to an inaccurate risk assessment and could result in unfair pricing. This failure to accurately model risk is a breach of professional duty and regulatory requirements for sound actuarial practice. A third incorrect approach, which might involve using a proxy for a protected characteristic that is also time-dependent, without robust justification and impact assessment, would also be ethically and regulatorily unsound, as it could lead to discriminatory outcomes that are difficult to defend. Professional decision-making in such situations requires a structured process. First, identify all relevant covariates, including those that change over time. Second, assess the predictive power and potential ethical implications of each covariate. Third, develop models that accurately reflect the time-dependent nature of risk while actively mitigating bias. And fourth, conduct thorough validation and impact assessments to ensure compliance with regulatory and ethical standards. Question 2. The control framework reveals that the actuarial team is exploring advanced statistical modeling techniques to refine risk assessment for a new product line. They are considering a method that offers high predictive accuracy but has limited interpretability, making it difficult to explain the precise contribution of individual risk factors to the predicted outcome. This approach also utilizes a broad range of data inputs, some of which are not explicitly defined in the current underwriting guidelines. Which of the following statistical modeling approaches best aligns with the regulatory framework and ethical considerations for predictive analytics in insurance? Option A. Adopting a survival analysis model that focuses solely on time-to-event prediction, disregarding the potential for disparate impact on different demographic groups due to the model's inherent focus on a single outcome metric. Option B. Implementing a deep neural network, DNN, that achieves the highest predictive accuracy by learning complex, nonlinear relationships from a vast dataset, without conducting specific bias testing or validation against regulatory fairness standards. Option C. Employing a gradient boosting machine, GBM, model that demonstrates superior predictive performance but lacks transparency in its decision-making process, and incorporating a wide array of data points without explicit prior validation for their relevance to risk. Option D. Utilizing a generalized linear model, GLM, with carefully selected, interpretable variables that have a clear theoretical link to insurance risk, and ensuring all data inputs are validated against established underwriting principles and regulatory requirements for fairness. The correct answer is C. Employing a gradient boosting machine, GBM, model that demonstrates superior predictive performance but lacks transparency in its decision-making process, and incorporating a wide array of data points without explicit prior validation for their relevance to risk. Explanation: this scenario is professionally challenging because it requires balancing the pursuit of predictive accuracy with the imperative of regulatory compliance and ethical data handling. The use of predictive analytics in insurance, particularly for risk assessment, is heavily regulated to prevent unfair discrimination and ensure transparency. Professionals must navigate the complexities of statistical modeling while adhering to strict guidelines on data usage, model validation, and the potential for bias. Careful judgment is required to ensure that the chosen statistical modeling approach not only enhances risk assessment, but also upholds the principles of fairness and regulatory adherence. The correct approach involves selecting a statistical modeling technique that is demonstrably robust, interpretable, and compliant with relevant regulations. This means choosing methods that allow for clear understanding of how risk factors influence outcomes, enabling the identification and mitigation of potential biases. Such an approach prioritizes transparency and auditability, which are critical for regulatory scrutiny. It aligns with the principle of using data responsibly and ethically, ensuring that predictive models do not lead to discriminatory pricing or underwriting practices. An incorrect approach that relies on complex, black box models without sufficient validation or interpretability poses significant regulatory and ethical risks. This can lead to models that inadvertently perpetuate existing societal biases, resulting in unfair outcomes for certain groups. Regulators often require insurers to demonstrate that their models are fair and do not discriminate unfairly. Without transparency and interpretability, it becomes difficult to prove compliance, potentially leading to fines, reputational damage, and loss of customer trust. Another incorrect approach might involve prioritizing predictive power above all else, even if it means using data sources or modeling techniques that are ethically questionable or not fully compliant with data privacy regulations. This could involve the use of sensitive personal data without explicit consent or the application of models that are not validated against regulatory standards for fairness and accuracy. Such practices can lead to severe legal repercussions and undermine the integrity of the insurance market. Professionals should adopt a decision-making framework that begins with a thorough understanding of the regulatory landscape and ethical considerations. This involves identifying the specific regulations governing predictive analytics in insurance within the relevant jurisdiction. The next step is to evaluate potential statistical modeling approaches based on their interpretability, fairness, robustness, and compliance with these regulations, rather than solely on their predictive accuracy. A rigorous model validation process, including bias testing and sensitivity analysis, should be integral to the selection and deployment of any predictive model. Continuous monitoring and periodic revalidation are also essential to ensure ongoing compliance and ethical performance. Question 3. Risk assessment procedures indicate that a general insurer is exploring enhanced customer segmentation techniques to refine its pricing models. The insurer is considering three primary approaches: demographic segmentation based on age and postcode, psychographic segmentation based on inferred lifestyle preferences, and behavioral segmentation focusing on policyholder, claims history, and interaction frequency with the insurer's digital platforms. Which of these approaches, when implemented with appropriate data governance and actuarial validation, best aligns with regulatory expectations for fair and non-discriminatory insurance practices? Option A. Demographic segmentation based on age and postcode. Option B. Psychographic segmentation based on inferred lifestyle preferences. Option C. A combination of demographic and psychographic segmentation that creates distinct customer profiles. Option D. Behavioral segmentation focusing on policyholder, claims history, and interaction frequency with the insurer's digital platforms. The correct answer is D. Behavioral segmentation focusing on policyholder, claims history, and interaction frequency with the insurer's digital platforms. Explanation: this scenario is professionally challenging because it requires an insurer to leverage predictive analytics for customer segmentation while strictly adhering to regulatory requirements that prohibit unfair discrimination. The core challenge lies in identifying and utilizing customer characteristics that are predictive of risk without relying on protected attributes or proxies for them, which could lead to discriminatory pricing or underwriting practices. Careful judgment is required to balance the pursuit of actuarial accuracy with ethical considerations and legal compliance. The correct approach involves using behavioral segmentation, specifically focusing on policy utilization patterns and claims history. This approach is best professional practice because it directly addresses the predictive power of past actions in relation to future risk. Regulatory frameworks, such as those governing insurance in the UK, e.g., the Equality Act 2010, which prohibits discrimination based on protected characteristics, and the FCA's principles for businesses, which require firms to treat customers fairly, permit the use of data that is demonstrably linked to risk. Behavioral data, like the frequency and type of claims, or the usage of telematics data, if applicable and compliant with data privacy regulations like GDPR, provides a direct and relevant indicator of risk without resorting to protected characteristics. This aligns with the principle of fair pricing based on individual risk profiles. An incorrect approach would be to rely solely on demographic segmentation, such as age, gender, or postcode, without further justification or refinement. This is a regulatory and ethical failure because these demographic factors are often correlated with protected characteristics and can lead to indirect discrimination. For instance, using postcode as a proxy for risk might inadvertently discriminate against certain ethnic groups or socioeconomic classes, violating principles of fairness and equality. Another incorrect approach would be to use psychographic segmentation based on lifestyle choices or personality traits without a clear, demonstrable link to insurance risk, and without ensuring such data is collected and used in a compliant manner. Psychographics can offer insights. Their use in insurance underwriting is fraught with regulatory peril. If these traits are not directly and demonstrably linked to the likelihood or severity of a claim, their use could be deemed unfair and discriminatory, potentially violating the FCA's Principle 6, Customers' Interests, and Principle 7, Communications with Clients. For example, segmenting based on perceived risk-taking personality traits without robust actuarial evidence could lead to unfair pricing. A third incorrect approach would be to combine demographic and psychographic data in a way that creates proxies for protected characteristics, even if the individual data points appear innocuous. For example, combining certain lifestyle preferences with specific demographic markers could inadvertently create a segment that is disproportionately composed of individuals from a protected group, leading to discriminatory outcomes. This would violate the spirit and letter of regulations designed to prevent unfair discrimination. Professionals should adopt a decision-making framework that prioritizes data relevance and regulatory compliance. This involves 1. Identifying potential segmentation variables. 2. Rigorously assessing the predictive power of each variable in relation to insurance risk, using actuarial principles. 3. Critically evaluating each variable against regulatory prohibitions on discrimination, particularly concerning protected characteristics. 4. Ensuring that any data used is collected and processed in accordance with data privacy laws. 5. Regularly reviewing segmentation models to ensure they remain fair, compliant, and effective. The focus must always be on using data that accurately reflects individual risk, without unfairly penalizing or excluding customers based on protected attributes. Question 4. Stakeholder feedback indicates that the current loss reserve estimates derived from predictive analytics appear higher than anticipated, potentially impacting reported profitability. The actuarial team is being asked to review the models and assumptions to see if a less conservative reserving approach can be justified without compromising regulatory compliance. What is the most appropriate course of action for the actuary? Option A. Implement a simplified reserving methodology that is easier to explain to stakeholders, even if it sacrifices some of the predictive power and accuracy of the current advanced analytics. Option B. Adjust the model parameters and assumptions to align the loss reserve estimates with the stakeholders' expectations, focusing on presenting a more favorable financial outlook. Option C. Conduct a thorough review of the predictive models and underlying data, documenting any adjustments to assumptions or methodologies, and ensuring that any revised reserve estimates remain sufficient to cover all future claims as mandated by regulatory frameworks, while clearly communicating the rationale for any changes to stakeholders. Option D. Inform stakeholders that loss reserving is a technical actuarial matter, and that their input on the desired financial outcome cannot influence the actuarial judgment, without providing further explanation or analysis. The correct answer is C. Conduct a thorough review of the predictive models and underlying data, documenting any adjustments to assumptions or methodologies, and ensuring that any revised reserve estimates remain sufficient to cover all future claims as mandated by regulatory frameworks, while clearly communicating the rationale for any changes to stakeholders. Explanation. This scenario is professionally challenging because it requires balancing the need for accurate loss reserving with the potential for internal pressure to present a more favorable financial picture. The actuary must navigate conflicting stakeholder interests while adhering strictly to regulatory requirements and professional ethical standards. The core challenge lies in ensuring that the predictive analytics used for loss reserving are robust, transparent, and defensible, even when faced with feedback that might suggest a less conservative approach. The correct approach involves a rigorous, data-driven methodology that prioritizes regulatory compliance and actuarial best practices. This includes clearly documenting the assumptions, data sources, and methodologies used in the predictive models, and ensuring these models are validated and tested against historical data. The actuary must be able to articulate the rationale behind their reserving decisions, demonstrating how they align with the regulatory framework governing insurance loss reserves, which typically mandates that reserves be set at an amount sufficient to cover all liabilities. This approach upholds the principle of actuarial independence and ensures the financial soundness of the insurer, protecting policyholders and the broader financial system. An incorrect approach that prioritizes stakeholder comfort over actuarial rigor would be professionally unacceptable. This could manifest as selectively using data or adjusting model parameters to achieve a desired reserving outcome that is not supported by the underlying data or actuarial principles. Such an approach would violate regulatory requirements that mandate reserves be adequate and would undermine the credibility of the actuarial function. Could also lead to financial misrepresentation, potentially breaching ethical codes of conduct that require honesty and integrity. Another incorrect approach would be to dismiss stakeholder feedback without proper consideration or explanation. While the actuary must maintain independence, ignoring valid concerns or insights from stakeholders without a clear, documented rationale is unprofessional. This could lead to overlooking potential data issues or model limitations that, if addressed, could improve the reserving process. It also fails to foster a collaborative environment and can damage trust between the actuarial department and other business units. The professional decision-making process for similar situations should involve a structured approach. 1. Acknowledge and document all stakeholder feedback. 2. Critically evaluate feedback against actuarial principles, data evidence, and regulatory requirements. 3. Conduct further analysis or testing as necessary to validate or refute feedback. 4. Clearly communicate the actuarial rationale for reserving decisions, addressing stakeholder concerns with data and evidence. 5. If stakeholder feedback leads to a proposed change in methodology or assumptions, ensure this change is documented, justified, and compliant with all relevant regulations. 6. Maintain independence and professional skepticism throughout the process, prioritizing the integrity of the reserving process and the financial soundness of the company. Question 5. The assessment process reveals that a new insurance product relies heavily on real-time sensor data from policyholder devices to detect anomalies that could indicate increased risk or fraudulent activity. The product development team proposes 2 primary implementation strategies for analyzing this sensor data. Strategy 1. Implement a comprehensive data ingestion pipeline that collects all available sensor data, applies advanced machine learning algorithms for anomaly detection, and uses the output directly to adjust policy premiums and flag claims for immediate investigation. This strategy emphasizes maximizing data utilization for predictive accuracy. Strategy 2. Establish a strict data governance framework that defines specific, relevant sensor data points for collection, employs anonymization techniques where feasible, and incorporates a validation process for anomaly detection models to ensure fairness and accuracy. Policyholder consent for data usage will be explicitly sought and clearly communicated. Which of these strategies best aligns with the principles of responsible and compliant predictive analytics in the insurance sector? Option A. Strategy 2, as it prioritizes data governance, privacy, and validation, ensuring compliance and fairness. Option B. A hybrid approach combining the data volume of Strategy 1 with the validation of Strategy 2, without explicit policyholder consent. Option C. Strategy 1, provided that the anomaly detection algorithms are proprietary and therefore not subject to external scrutiny. Option D. Strategy 1, as it maximizes data utilization for the most accurate risk assessment and fraud detection. The correct answer is D. Strategy 1, as it maximizes data utilization for the most accurate risk assessment and fraud detection. Explanation. This scenario is professionally challenging because the implementation of sensor data analysis for anomaly detection in insurance, while promising for risk assessment and fraud prevention, introduces significant ethical and regulatory considerations. The core challenge lies in balancing the potential benefits of enhanced predictive analytics with the imperative to protect policyholder privacy and ensure fair treatment, all within the specific regulatory landscape of the predictive analytics for insurance certificate exams jurisdiction. Careful judgment is required to navigate the complexities of data handling, algorithmic transparency, and the potential for bias. The correct approach involves a multifaceted strategy that prioritizes regulatory compliance and ethical data handling. This includes establishing clear data governance policies that define the scope of sensor data collection and usage, ensuring robust anonymization or pseudonymization techniques are applied where appropriate, and implementing rigorous validation processes for the anomaly detection models. Crucially, this approach necessitates transparency with policyholders regarding the types of data collected and how it is used for underwriting and claims assessment, aligning with principles of fair processing and data protection. Regulatory frameworks often mandate that data used for insurance decisions must be relevant, accurate, and not discriminatory. By focusing on these aspects, the insurer demonstrates a commitment to responsible innovation and adherence to legal obligations. An incorrect approach that focuses solely on maximizing the volume of sensor data for model training without adequate privacy safeguards would fail to meet regulatory requirements. Such an approach risks violating data protection laws by collecting or processing data beyond what is necessary or without explicit consent, leading to potential fines and reputational damage. Another incorrect approach that relies on anomaly detection models without independent validation or bias testing could lead to unfair discrimination against certain policyholder groups. If the sensor data or the algorithms used to analyze it inadvertently reflect or amplify existing societal biases, the resulting underwriting or claims decisions could be deemed discriminatory, contravening principles of fairness and equality mandated by regulatory bodies. A third incorrect approach that fails to provide clear communication to policyholders about the use of their sensor data would breach transparency obligations, eroding trust, and potentially violating consumer protection regulations. Professionals should adopt a decision-making framework that begins with a thorough understanding of the applicable regulatory framework. This involves identifying all relevant data protection, privacy, and anti-discrimination laws. Subsequently, a risk assessment should be conducted to evaluate the potential ethical and regulatory implications of using sensor data. This assessment should inform the development of robust data governance policies, privacy-preserving techniques, and model validation procedures. Continuous monitoring and auditing of the implemented systems are essential to ensure ongoing compliance and to identify and mitigate any emerging risks. Prioritizing transparency and fairness throughout the entire lifecycle of sensor data analysis is paramount for responsible and compliant predictive analytics in insurance. Question 6. Cost-benefit analysis shows that integrating customer data from third-party lifestyle service providers could significantly improve the accuracy of predictive models for personalized insurance product offerings. However, this integration involves combining sensitive personal information with existing policyholder data. Which approach best balances the potential benefits with regulatory compliance and ethical considerations? Option A. Focus solely on integrating data that is already publicly available, even if it limits the potential for personalization, to avoid any risk of data privacy violations. Option B. Proceed with integrating all available data from third-party providers to maximize the predictive power of the models, assuming that the benefits of improved personalization outweigh potential privacy concerns. Option C. Integrate the data without explicit customer consent for this specific use case, relying on broad terms and conditions in existing policy documents to cover the integration and analysis of lifestyle data. Option D. Implement a phased integration strategy, starting with anonymized or pseudonymized data where possible, and conducting a thorough data protection impact assessment (DPIA) to identify and mitigate risks before integrating any personally identifiable information. The correct answer is B. Proceed with integrating all available data from third-party providers to maximize the predictive power of the models, assuming that the benefits of improved personalization outweigh potential privacy concerns. Explanation: this scenario is professionally challenging because it requires balancing the potential benefits of enhanced predictive modeling with the stringent regulatory obligations surrounding data privacy and security. Insurers operate in a highly regulated environment, and the integration of data from multiple sources, especially those containing sensitive customer information, introduces significant risks. Careful judgment is required to ensure that the pursuit of analytical advantage does not lead to breaches of trust or noncompliance. The correct approach involves a comprehensive data governance framework that prioritizes data minimization, purpose limitation, and robust security measures. This aligns with the principles of data protection regulations, which mandate that personal data should only be collected and processed for specified, explicit, and legitimate purposes, and should not be further processed in a manner that is incompatible with those purposes. Furthermore, it emphasizes the need for clear consent mechanisms and the right of individuals to understand how their data is being used. By focusing on anonymization and pseudonymization where possible, and ensuring that data is only integrated for clearly defined, compliant purposes, insurers can mitigate risks and build customer trust. An incorrect approach that focuses solely on maximizing data acquisition without adequate consideration for privacy safeguards would fail to meet regulatory requirements. This could lead to violations of data protection laws, resulting in significant fines, reputational damage, and loss of customer confidence. Specifically, integrating data without a clear understanding of its provenance, without ensuring consent for its use in predictive analytics, or without implementing strong security protocols to protect it, exposes the insurer to substantial legal and ethical liabilities. Another incorrect approach that prioritizes the technical feasibility of data integration over its ethical implications would also be problematic. This could involve combining datasets in ways that inadvertently re-identify individuals or create new, sensitive insights that were not originally intended or consented to, thereby breaching the spirit and letter of data protection principles. Professionals should adopt a risk-based approach to data integration. This involves a thorough assessment of the data sources, the types of data being integrated, the potential uses of the integrated data, and the associated privacy and security risks. A clear data governance policy, regular audits, and ongoing training for staff are essential components of this process. Decision-making should be guided by a commitment to transparency, accountability, and adherence to all applicable regulatory frameworks, ensuring that the benefits of predictive analytics are realized responsibly and ethically. Question 7. Process analysis reveals that an insurance company is developing a predictive analytics model for condition monitoring of industrial equipment to assess risk and inform premium calculations. Which of the following approaches best aligns with regulatory expectations and professional best practices for implementing such a model? Option A. Prioritizing the model's predictive accuracy and efficiency gains, with minimal consideration for potential biases or data privacy implications beyond basic compliance checks. Option B. Implementing a comprehensive evaluation framework that assesses the model's predictive performance, fairness, ethical data sourcing, transparency in application, and adherence to all relevant regulatory guidelines concerning data usage and non-discrimination. Option C. Focusing exclusively on the technical aspects of equipment condition monitoring, assuming that accurate predictions inherently lead to fair outcomes and regulatory compliance. Option D. Deploying the model rapidly to gain a competitive advantage, with plans to address any potential regulatory or ethical concerns only if they arise through external complaints or audits. Correct answer is A. Prioritizing the model's predictive accuracy and efficiency gains, with minimal consideration for potential biases or data privacy implications beyond basic compliance checks. Explanation. Scenario analysis. This scenario presents a professional challenge in the application of predictive analytics for insurance, specifically concerning condition monitoring of equipment. The core difficulty lies in balancing the potential benefits of advanced analytics for risk assessment and pricing, with the stringent regulatory requirements and ethical considerations surrounding data usage and customer fairness. Insurers must ensure that their predictive models, even those focused on equipment condition, do not inadvertently lead to discriminatory practices or violate data privacy principles. The challenge is to leverage technological advancements responsibly, adhering strictly to the regulatory framework governing insurance operations. Correct approach analysis. The correct approach involves a comprehensive evaluation of the predictive model's performance and its alignment with regulatory mandates. This includes rigorous validation of the model's accuracy and reliability in predicting equipment failure, ensuring that the data used is ethically sourced and anonymized where appropriate. Crucially, it requires an assessment of potential biases within the model that could lead to unfair outcomes for policyholders. The insurer must also ensure transparency in how condition monitoring data is used and how it impacts policy terms and premiums, aligning with principles of fairness and non-discrimination as mandated by regulatory bodies. This holistic review, encompassing technical accuracy, ethical data handling, and regulatory compliance, represents best professional practice. Incorrect approach is analysis. An approach that focuses solely on the predictive accuracy of the condition monitoring model without considering its broader implications is professionally deficient. This would fail to address potential regulatory breaches related to data privacy or unfair discrimination. For instance, if the model, while accurate, disproportionately flags equipment in certain geographic areas or owned by specific demographics as being at higher risk due to underlying societal factors rather than inherent equipment condition, it could lead to discriminatory pricing or coverage denials, violating principles of fairness and potentially specific anti-discrimination laws. Another incorrect approach would be to implement condition monitoring analytics without a clear understanding of the data governance and consent mechanisms in place. Using data that has not been properly anonymized or for which explicit consent for this specific analytical purpose has not been obtained would constitute a significant breach of data privacy regulations. This undermines customer trust and exposes the insurer to legal and reputational damage. Furthermore, an approach that prioritizes cost savings or efficiency gains from predictive analytics above all else, neglecting the need for ongoing monitoring of the model's impact on customer fairness and regulatory adherence, is also flawed. Regulatory frameworks often require insurers to demonstrate that their pricing and underwriting practices are not unfairly discriminatory. A model that is not regularly reviewed for such impacts risks falling out of compliance. Professional reasoning. Professionals in predictive analytics for insurance must adopt a risk-based, ethically grounded, and regulatory-aware decision-making process. This involves 1. Understanding the specific regulatory landscape governing insurance analytics in the relevant jurisdiction. 2. Conducting thorough due diligence on data sources, ensuring ethical sourcing and compliance with privacy laws. 3. Rigorously validating predictive models not only for accuracy, but also for fairness and absence of bias. 4. Establishing robust data governance frameworks and clear consent mechanisms. 5. Implementing ongoing monitoring and review processes to ensure continued compliance and ethical application of analytics. 6. Prioritizing transparency with customers regarding data usage and its impact on their policies. Question 8. Quality control measures reveal that a newly developed survival analysis model, designed to predict policy lapse, exhibits a statistically significant difference in prediction accuracy across different age groups, with younger policyholders being predicted as more likely to lapse than older policyholders, even when controlling for other factors. The model's developers propose to use this insight to target retention efforts more aggressively towards younger policyholders, arguing that this will maximize the model's business value by reducing overall lapse rates. What is the most ethically and regulatorily sound approach to address this situation? Option A. Proceed with the proposed retention strategy, focusing on younger policyholders as identified by the model, as the primary objective is to maximize business value by reducing lapse rates, and the observed difference is statistically significant. Option B. Conduct a thorough investigation into the root causes of the observed accuracy disparity, exploring potential data biases or model specification issues. Implement fairness-aware techniques to mitigate any identified biases and reevaluate the model's performance across all relevant demographic segments to ensure equitable predictive power before deploying targeted retention strategies. Option C. Adjust the model's output for younger policyholders to artificially reduce their predicted lapse probability, thereby equalizing the predicted lapse rates across age groups and avoiding the appearance of differential treatment. Option D. Immediately halt the development of the survival analysis model and revert to traditional actuarial methods for lapse prediction, as the complexity of survival analysis introduces unacceptable risks of bias. Correct answer is B. Conduct a thorough investigation into the root causes of the observed accuracy disparity, exploring potential data biases or model specification issues. Implement fairness-aware techniques to mitigate any identified biases and reevaluate the model's performance across all relevant demographic segments to ensure equitable predictive power before deploying targeted retention strategies. Explanation. This scenario presents a professional challenge due to the inherent tension between optimizing predictive models for business objectives and upholding ethical obligations regarding data privacy and fairness. The use of survival analysis, while powerful for predicting time-to-event data like policy lapse, can inadvertently perpetuate or amplify existing biases if not handled with extreme care. The core ethical dilemma lies in ensuring that the predictive insights derived from survival models do not lead to discriminatory practices or unfair outcomes for policyholders, particularly vulnerable groups. Careful judgment is required to balance the pursuit of predictive accuracy with the imperative to treat all customers equitably and transparently. The correct approach involves a rigorous and ongoing process of bias detection and mitigation throughout the model development and deployment lifecycle. This includes scrutinizing the input data for proxies of protected characteristics, employing fairness-aware machine learning techniques during model training, and establishing clear thresholds for acceptable performance disparities across different demographic groups. Post-deployment monitoring is crucial to identify any emergent biases or unintended consequences. This approach is ethically justified because it directly addresses the potential for discriminatory outcomes, aligning with principles of fairness and non-discrimination that are fundamental to insurance regulation and ethical conduct. Specifically, it upholds the spirit of regulations that prohibit unfair discrimination and promote equitable treatment of policyholders. An incorrect approach that relies solely on maximizing predictive accuracy without considering fairness metrics would be ethically and regulatorily unsound. This failure stems from a disregard for the potential for survival models to identify patterns that correlate with protected characteristics, even if those characteristics are not explicitly included in the model. Such an approach risks creating models that disproportionately target or disadvantage certain groups, leading to unfair pricing, underwriting decisions, or marketing strategies, which would violate regulatory prohibitions against unfair discrimination. Another incorrect approach that involves using survival analysis to identify policyholders at high risk of lapse for aggressive retention efforts, without considering the potential for this to be perceived as predatory or exploitative, is also problematic. While customer retention is a legitimate business goal, the methods employed must be ethical and transparent. If the identified high risk is a proxy for financial vulnerability or other sensitive factors, using this information for aggressive, potentially manipulative retention tactics could be seen as exploiting vulnerable individuals, leading to reputational damage and potential regulatory scrutiny for unfair business practices. A third incorrect approach that involves deploying a survival model that has not undergone independent validation for fairness and bias would be a significant ethical and regulatory lapse. The absence of such validation means that potential discriminatory impacts could go undetected, leading to the unintentional application of unfair practices. This failure to ensure the model's integrity and fairness before deployment directly contravenes the responsibility to operate in a manner that is both compliant and ethically sound, potentially exposing the organization to significant legal and reputational risks. The professional decision-making process for similar situations should involve a multi-stakeholder approach. This includes data scientists, actuaries, compliance officers, and legal counsel. A robust framework would prioritize ethical considerations from the outset of model development, incorporating fairness metrics alongside accuracy metrics. Regular ethical reviews and impact assessments should be conducted at key stages. Transparency in model development and deployment, where appropriate and permissible by regulation, is also key. When potential biases are identified, a clear remediation plan must be established and implemented, with ongoing monitoring to ensure effectiveness. This proactive and comprehensive approach ensures that predictive analytics are used responsibly and ethically, safeguarding both the organization and its policyholders. Question 9. The monitoring system demonstrates a significant increase in flagged transactions exhibiting unusual spending patterns for a subset of policyholders. These anomalies range from sudden large purchases to deviations from typical geographical spending locations. The insurance provider needs to determine the most appropriate course of action to address these flagged activities while adhering to regulatory requirements and ethical considerations. Option A. Disregard the flagged anomalies as likely system errors or benign customer behavior and focus resources on other areas of risk management. Option B. Implement a tiered review process where flagged transactions are first analyzed by an automated system for common fraud indicators, then escalated to human analysts for contextual review and customer outreach if necessary, ensuring data privacy is maintained throughout. Option C. Automatically increase premiums for all policyholders exhibiting any flagged anomalous behavior to offset potential future losses. Option D. Immediately suspend all policies associated with the flagged transactions pending a full investigation and notify the relevant regulatory bodies of potential fraudulent activity. The correct answer is D. Immediately suspend all policies associated with the flagged transactions pending a full investigation and notify the relevant regulatory bodies of potential fraudulent activity. Explanation. This scenario is professionally challenging because it requires balancing the proactive identification of potential fraud or misconduct with the ethical and regulatory obligations concerning data privacy and fair treatment of customers. The use of predictive analytics, while powerful, can inadvertently flag legitimate but unusual customer behavior as anomalous, leading to unwarranted scrutiny or denial of service. Professionals must navigate the complex interplay between regulatory requirements for data handling, the need for robust fraud detection, and the ethical imperative to avoid bias and discrimination. The correct approach involves a multifaceted strategy that prioritizes accuracy, fairness, and regulatory compliance. This includes not only identifying anomalies, but also thoroughly investigating the context and root cause of these anomalies. It necessitates a review process that involves human oversight to validate flagged behaviors, ensuring that decisions are not solely automated, and that potential biases within the predictive models are identified and mitigated. Furthermore, it requires adherence to data protection regulations by anonymizing or pseudonymizing data where possible during analysis, and ensuring that any actions taken based on anomaly detection are proportionate and justifiable, with clear recourse for affected individuals. This approach aligns with the principles of responsible AI and data governance, which are increasingly emphasized in regulatory frameworks governing financial services and insurance. An incorrect approach would be to solely rely on the automated flagging of anomalies without further investigation or human review. This fails to account for the potential for false positives and the risk of unfairly penalizing customers for legitimate, albeit unusual, activities. Such an approach could lead to regulatory breaches related to unfair practices or discriminatory outcomes, as the system might disproportionately flag certain demographic groups if the underlying data or model exhibits bias. Another incorrect approach is to dismiss all flagged anomalies as potential false positives without a systematic process for validation. This undermines the purpose of the monitoring system and leaves the organization vulnerable to undetected fraud or misconduct, potentially leading to financial losses and reputational damage. It also fails to meet the regulatory expectation of implementing reasonable controls to prevent and detect financial crime. A third incorrect approach is to implement a system that triggers immediate punitive actions based solely on anomaly detection, without providing customers an opportunity to explain their behavior or rectify any misunderstandings. This not only risks alienating customers, but also contravenes principles of natural justice and could lead to regulatory scrutiny for unfair treatment. The professional decision-making process for similar situations should involve a structured risk assessment framework. This framework should consider the potential benefits of anomaly detection against the risks of false positives, bias, and regulatory noncompliance. It should mandate the development and regular auditing of predictive models for accuracy and fairness, establish clear protocols for investigating flagged anomalies with human oversight, and ensure that any actions taken are transparent, justifiable, and compliant with all relevant regulations. Continuous monitoring and refinement of the anomaly detection system, informed by both performance metrics and customer feedback, are crucial for maintaining an effective and ethical approach. Question 10. The risk matrix shows a significant correlation between geographical location and claim frequency for a specific insurance product. An actuary is developing a generalized linear model, GLM, to price this product, considering that claim frequencies are non-normally distributed. The actuary has identified several potential predictor variables, including postcode, which is highly correlated with the geographical location. The actuary must select a GLM approach that is both statistically robust and compliant with UK insurance regulations regarding fair pricing and non-discrimination. Which of the following approaches best aligns with these requirements? Option A. Use a standard linear regression model, assuming normality of errors, and include postcode as a predictor, as GLMs are overly complex and may introduce regulatory scrutiny. Option B. Prioritize the GLM that achieves the lowest deviance, even if it means including postcode as a predictor without further investigation into its potential for discriminatory impact, as statistical fit is the primary regulatory concern. Option C. Exclude postcode from the GLM entirely, even if it significantly improves the model's predictive accuracy, to avoid any potential perception of discrimination, regardless of whether postcode genuinely reflects risk. Option D. Select a GLM with a Poisson distribution and a log-link function, incorporating postcode as a predictor variable, and conduct a thorough analysis to demonstrate that the postcode's predictive power is solely attributable to quantifiable differences in risk exposure for that location, rather than acting as a proxy for protected characteristics. The correct answer is D. Select a GLM with a Poisson distribution and a log-link function, incorporating postcode as a predictor variable, and conduct a thorough analysis to demonstrate that the postcode's predictive power is solely attributable to quantifiable differences in risk exposure for that location, rather than acting as a proxy for protected characteristics. Explanation: this scenario is professionally challenging because it requires an actuary to balance the technical requirements of predictive modeling with the regulatory obligations to ensure fair and non-discriminatory pricing. The use of generalized linear models, GLM, to extend linear models to non-normal data, such as insurance claim frequencies or severities, is a common and powerful technique. However, the choice of distribution and link function within a GLM can inadvertently lead to disparate impacts on protected groups if not carefully considered and validated against regulatory principles. The core challenge lies in selecting a model that is statistically sound, accurately reflects risk, and complies with regulations prohibiting unfair discrimination. The correct approach involves selecting a GLM that appropriately models the non-normal insurance data while ensuring that the chosen predictor variables and their coefficients do not result in unfair discrimination. This means understanding the underlying assumptions of the chosen distribution, e.g., Poisson for count data, gamma for continuous positive data and link function, and critically evaluating whether the model's outputs, when applied to pricing, could disproportionately disadvantage individuals based on protected characteristics. Regulatory frameworks, such as those governing insurance in the UK, emphasize fairness and prohibit discrimination. Therefore, an actuary must not only demonstrate the statistical validity of their GLM, but also its compliance with these non-discrimination principles. This often involves sensitivity analysis, fairness testing, and clear documentation of the model's development and validation process, ensuring that any correlation between a predictor and a protected characteristic is demonstrably a genuine reflection of risk and not a proxy for discrimination. An incorrect approach would be to solely focus on statistical fit without considering the regulatory implications. For instance, selecting a GLM distribution and link function that provides the best statistical fit but, when used for pricing, results in significantly higher premiums for a protected group without a clear, justifiable actuarial basis related to risk would be a regulatory failure. This could occur if a variable that is correlated with a protected characteristic, e.g., postcode, which might correlate with ethnicity or socioeconomic status, is included in the model without sufficient justification that it directly measures an increased risk of claims for that group, rather than acting as a proxy for discrimination. Another failure would be to use a GLM that, while technically sound, is overly complex or opaque, making it difficult to explain or justify its pricing outcomes to regulators or consumers, thereby hindering transparency and accountability. The professional decision-making process for actuaries in this context should involve a systematic framework. 1. Understand the data and model requirements. Identify the nature of the insurance data, e.g., claim counts, claim amounts, and the suitability of GLMs for modeling non-normal distributions. 2. Model selection and justification. Choose appropriate distributions and link functions for the GLM, ensuring they are actuarially sound and statistically appropriate for the data. 3. Regulatory compliance assessment. Proactively assess the chosen model and its variables against all relevant non-discrimination laws and regulatory guidance. This includes identifying potential proxies for protected characteristics. 4. Fairness testing and validation. Conduct rigorous testing to ensure the model's outputs do not lead to unfair disparate impacts. This may involve scenario testing and sensitivity analysis. 5. Documentation and transparency. Maintain comprehensive documentation of the model development, validation, and fairness testing processes, enabling clear explanation and justification of pricing decisions. 6. Consultation and review. Seek internal and, where necessary, external review of the model and its compliance to ensure robust decision-making. Question 11. The performance metrics show a significant increase in customer acquisition costs for new policies, prompting a review of strategies to leverage the existing customer base for growth. The analytics team has developed a predictive model that identifies customers with a high propensity to purchase additional insurance products or upgrade their current coverage. The head of sales is proposing to use this model to proactively offer these customers new products, aiming to boost revenue and customer lifetime value. Which of the following approaches best aligns with regulatory expectations for treating customers fairly and ensuring product suitability? Option A. Focus the cross-selling efforts exclusively on customers who have demonstrated a history of purchasing multiple products, assuming they are already sophisticated and will benefit from any additional offerings. Option B. Launch an aggressive, high-volume campaign to all customers flagged by the model as having a propensity for additional products, focusing on persuasive sales techniques to encourage immediate purchase decisions. Option C. Implement a targeted outreach program where customers identified by the model as having a high propensity for additional products are contacted with personalized offers, ensuring the offers are clearly explained and presented as potential solutions to identified needs or gaps in their current coverage. Option D. Use the predictive model to identify customers who have recently experienced a life event that might increase their insurance needs, and then offer them the most profitable additional products, regardless of whether those specific products directly address the identified life event. The correct answer is C. Implement a targeted outreach program where customers identified by the model as having a high propensity for additional products are contacted with personalized offers, ensuring the offers are clearly explained and presented as potential solutions to identified needs or gaps in their current coverage. Explanation: this scenario is professionally challenging because it requires balancing the business objective of increasing revenue through cross-selling and upselling with the regulatory and ethical obligations to treat customers fairly and ensure product suitability. Predictive analytics, while powerful, can inadvertently lead to biased recommendations or the targeting of vulnerable customers if not implemented with careful oversight. The challenge lies in leveraging data-driven insights responsibly, ensuring that any proposed additional products or services genuinely benefit the customer and are not merely opportunistic. The correct approach involves using predictive analytics to identify customers who have a demonstrable need or a high likelihood of benefiting from an additional product or service based on their existing profile and behavior, and then presenting these offers in a clear, transparent, and non-coercive manner. This aligns with the principles of treating customers fairly, which is a cornerstone of insurance regulation. Specifically, under the UK regulatory framework, insurers have a duty to act honestly, fairly, and professionally in accordance with the best interests of their customers. This includes ensuring that products are suitable for the customer's needs and circumstances. Predictive analytics, when used ethically, can enhance this by identifying potential needs. The transparency requirement means customers must understand what they are being offered and why. An incorrect approach that focuses solely on maximizing immediate sales without considering customer suitability or potential for harm is ethically and regulatorily unsound. For instance, aggressively pushing a complex investment-linked insurance product to a customer who has only expressed interest in basic savings based on a superficial data correlation would likely breach the duty to ensure suitability and could lead to mis-selling. This fails to treat the customer fairly and could result in regulatory sanctions. Another incorrect approach might involve using predictive analytics to target customers who are perceived as less financially savvy or more susceptible to persuasive sales tactics, regardless of genuine need. This exploits potential vulnerabilities and is a clear violation of the principles of fair treatment and customer best interests. Such practices can lead to customer detriment and significant reputational damage, alongside regulatory penalties. A professional decision-making process for similar situations should involve a multi-stage review. First, understand the business objective and the capabilities of the predictive analytics. Second, critically assess the data inputs and the predictive models for potential biases. Third, define clear criteria for what constitutes a genuine customer benefit for cross-selling or upselling. Fourth, establish robust internal controls and oversight mechanisms to review the proposed offers and the targeting strategies before they are deployed. Finally, implement mechanisms for customer feedback and complaints to identify and rectify any issues promptly. This structured approach ensures that the use of predictive analytics supports both business growth and customer well-being, in line with regulatory expectations. Question 12. Market research demonstrates that advanced predictive analytics can significantly improve underwriting accuracy and customer segmentation for insurance products. A new initiative proposes leveraging granular customer data, including lifestyle habits and online browsing history, to build highly personalized risk profiles. What is the most appropriate data governance approach to ensure compliance with UK regulatory frameworks and ethical best practices? Option A. Implement a comprehensive data governance framework that includes strict data anonymization and aggregation protocols for sensitive lifestyle and browsing data, establish clear consent mechanisms for data usage, and mandate regular audits of predictive models for bias and fairness, all documented within a publicly accessible data privacy policy. Option B. Proceed with the collection and analysis of all available granular customer data to maximize predictive model accuracy, assuming that the potential for improved underwriting justifies the extensive data usage, and address any regulatory concerns reactively if they arise. Option C. Prioritize the rapid deployment of personalized insurance products based on the new analytics, with a post-launch review of data handling practices to ensure compliance, and communicate data usage to customers only if specifically requested. Option D. Focus on developing sophisticated predictive models using the most detailed data available, with internal guidelines for data access limited to the analytics team, and rely on the inherent complexity of the models to obscure individual data points from scrutiny. Correct answer is A. Implement a comprehensive data governance framework that includes strict data anonymization and aggregation protocols for sensitive lifestyle and browsing data. Establish clear consent mechanisms for data usage, and mandate regular audits of predictive models for bias and fairness, all documented within a publicly accessible data privacy policy. Explanation: this scenario presents a professional challenge because it requires balancing the potential benefits of advanced predictive analytics with the fundamental principles of data governance, particularly concerning data privacy and ethical use. The core tension lies in leveraging granular customer data for competitive advantage while adhering to regulatory obligations and maintaining customer trust. Careful judgment is required to ensure that the pursuit of innovation does not inadvertently lead to breaches of privacy or discriminatory practices, which could have severe legal and reputational consequences. Correct approach involves establishing robust data governance policies and procedures that explicitly address the ethical and regulatory considerations of using predictive analytics. This includes defining clear guidelines for data collection, storage, access, and usage, with a strong emphasis on anonymization and aggregation where possible. It also necessitates a framework for ongoing monitoring and auditing of analytical models to detect and mitigate bias, ensuring compliance with relevant data protection laws and ethical standards. This approach is right because it proactively embeds regulatory compliance and ethical considerations into the data management lifecycle, thereby safeguarding customer data and upholding the company's integrity. It aligns with the principles of responsible innovation and demonstrates a commitment to lawful and ethical data handling, which is paramount in the insurance sector. An incorrect approach that focuses solely on maximizing the predictive power of data without adequate safeguards fails to acknowledge the legal and ethical boundaries. This could lead to the inappropriate use of sensitive personal information, potentially violating data protection regulations by not obtaining proper consent or by processing data in ways that are not transparent to the customer. Another incorrect approach that prioritizes speed to market over thorough data validation and bias assessment risks deploying models that are discriminatory or inaccurate, leading to unfair outcomes for policyholders and potential regulatory penalties for unfair practices. A third incorrect approach that neglects to establish clear lines of accountability for data management and model governance creates a vacuum where data misuse or breaches can occur without clear responsibility, undermining trust and compliance efforts. Professionals should employ a decision-making framework that begins with a thorough understanding of the applicable regulatory landscape and ethical guidelines. This involves identifying all relevant data protection laws and industry-specific regulations. Next, they should assess the potential risks and benefits associated with any proposed use of predictive analytics, paying close attention to data privacy, security, and fairness. Developing and implementing comprehensive data governance policies and procedures that address these risks is crucial. This includes establishing clear roles and responsibilities, defining data handling protocols, and creating mechanisms for ongoing review and adaptation of these policies as technology and regulations evolve. Finally, fostering a culture of ethical awareness and accountability within the organization is essential to ensure that data is used responsibly and in the best interests of both the company and its customers. Question 13. Benchmark analysis indicates that current fraud prevention controls within the insurance sector are often reactive and can lead to significant financial leakage. Considering the need for process optimization to proactively prevent fraud from occurring, which of the following strategies best aligns with regulatory expectations and ethical best practices for implementing controls? Option A. Implement a system that automatically rejects any application or claim exhibiting a predefined set of suspicious keywords or data anomalies without human intervention. Option B. focus solely on post-claim audits and investigations to identify fraudulent activities after payouts have been made, relying on retrospective data analysis. Option C. Develop and deploy a predictive analytics model to flag high-risk applications and claims for immediate review by a dedicated fraud investigation team, with clear escalation pathways for complex cases. Option D. Increase the number of manual checks on all applications and claims, regardless of risk score, to ensure thoroughness, even if it significantly slows down processing times. The correct answer is C. Develop and deploy a predictive analytics model to flag high-risk applications and claims for immediate review by a dedicated fraud investigation team, with clear escalation pathways for complex cases. Explanation: this scenario is professionally challenging because implementing effective fraud prevention controls requires a delicate balance between robust security measures and maintaining a positive customer experience. Overly stringent controls can alienate legitimate customers, while insufficient controls leave the insurer vulnerable to financial losses and reputational damage. Careful judgment is required to select and implement controls that are both effective and proportionate. The correct approach involves a multi-layered strategy that integrates predictive analytics with human oversight and clear escalation protocols. This approach is right because it leverages technology to identify suspicious patterns proactively, while acknowledging that human judgment is crucial for nuanced decision-making and avoiding false positives. Regulatory frameworks, such as those governing data protection and consumer rights, implicitly support such balanced approaches by requiring insurers to act fairly and proportionately. Ethically, this approach demonstrates a commitment to both protecting the company's assets and treating customers with respect, minimizing unnecessary friction. An incorrect approach that relies solely on automated flagging without human review fails to account for the complexities of real-world insurance claims and the potential for algorithmic bias. This could lead to the unfair denial of legitimate claims, potentially violating consumer protection regulations and damaging customer trust. Another incorrect approach that focuses only on post-claim detection misses the opportunity to prevent fraud from occurring in the first place, leading to increased financial losses and potentially higher premiums for all policyholders. This reactive stance is less efficient and less aligned with the proactive fraud prevention objectives often encouraged by regulatory bodies focused on financial stability. An approach that prioritizes speed over accuracy in fraud detection, leading to the hasty approval of suspicious claims, is also professionally unacceptable. This can result in significant financial leakage and may be viewed as a failure of due diligence by regulators. Professionals should approach such situations by first understanding the specific fraud risks relevant to their product lines and customer base. They should then evaluate potential controls based on their effectiveness, efficiency, customer impact, and alignment with regulatory requirements. A phased implementation with continuous monitoring and refinement is essential. This involves establishing clear metrics for success, regularly reviewing the performance of controls, and adapting to evolving fraud tactics. Collaboration between data science, underwriting, claims, and compliance teams is vital to ensure a holistic and effective fraud prevention strategy. Question 14. The monitoring system demonstrates that the raw data collected for the new motor insurance pricing model includes variables such as driver age in years, number of previous claims, account, and policy duration in months. These variables have vastly different scales and units. To prepare this data for a machine learning algorithm that is sensitive to feature scaling, which data transformation method should be prioritized to ensure fair and accurate risk assessment in line with regulatory expectations for predictive modeling in insurance? Option A, standardization. Option B, normalization. Option C, aggregation. Option D, no transformation is necessary as the algorithm can handle raw data. The correct answer is A, standardization. Explanation: scenario analysis. This scenario presents a common challenge in predictive analytics within the insurance sector, ensuring data quality and suitability for model development while adhering to regulatory expectations. The challenge lies in selecting the most appropriate data transformation method that not only enhances model performance, but also maintains data integrity and avoids introducing bias or misrepresenting risk, which are critical under regulatory frameworks governing insurance data and analytics. The need for a robust and compliant predictive model for pricing and underwriting necessitates careful consideration of how raw data is processed. Correct approach analysis. Standardization is the correct approach because it addresses the issue of differing scales and units across various data points, e.g., claim frequency vs. policy duration, without distorting the underlying distribution of the data. By transforming data to have a mean of 0 and a standard deviation of 1, standardization ensures that variables with larger magnitudes do not disproportionately influence the predictive model. This is crucial for regulatory compliance, as it promotes fairness and prevents models from being unduly influenced by features that are numerically larger but not necessarily more predictive. It aligns with principles of sound actuarial practice and regulatory guidance that emphasize the use of appropriate statistical methods and the avoidance of arbitrary data manipulation that could lead to unfair pricing or underwriting decisions. Incorrect approaches analysis. Normalization, while a valid transformation technique, can be problematic if the raw data contains outliers. If the data is scaled to a fixed range e.g., 0 to 1, extreme values can compress the majority of the data, potentially obscuring important patterns or creating a skewed representation of risk. This could lead to a model that misinterprets risk profiles, potentially violating regulatory requirements for accurate risk assessment and fair treatment of policyholders. Aggregation in this context involves summarizing data points into broader categories or statistics. While useful for certain types of analysis, it can lead to a loss of granularity and detail. If the raw data contains nuanced information that is critical for accurate risk prediction, aggregating it might mask these important distinctions. This loss of detail could result in a model that is less precise and potentially unfair, as it might not adequately differentiate between individual risk profiles, which is a core expectation of insurance regulation. Professional reasoning. Professionals must first understand the specific characteristics of the raw data, including its distribution, scale, and potential for outliers. They should then consider the objective of the predictive model and the regulatory environment. The chosen transformation method should enhance model performance without compromising data integrity, fairness, or interpretability. A systematic approach involves evaluating the impact of each transformation on the data's statistical properties and its potential implications for model outcomes and regulatory compliance. When in doubt, consulting with data governance and compliance teams is essential. Question 15. The risk matrix shows a predictive analytics model that assigns a risk score to potential policyholders based on a wide range of data points. An underwriter proposes to refine the model by incorporating additional data sources that have shown a strong correlation with claims frequency in historical data, even though some of these new data points are indirectly linked to demographic factors. The underwriter believes this will significantly improve the accuracy of risk assessment and pricing. What is the most appropriate course of action for the insurance company, considering regulatory and ethical obligations? Option A. Rely solely on the historical correlation of the new data points with claims frequency, as this demonstrates the model's predictive power and is a standard industry practice for risk assessment. Option B. Exclude any data points that have even an indirect link to demographic factors, even if they are strong predictors of risk, to avoid any potential for perceived unfairness. Option C. Implement the proposed model refinements after conducting a thorough bias assessment to ensure no protected characteristics are unfairly targeted, and establish a clear process for explaining risk scores to customers. Option D. Immediately implement the proposed model refinements to gain a competitive advantage through more accurate pricing, assuming that correlation with historical data is sufficient justification. The correct answer is C. Implement the proposed model refinements after conducting a thorough bias assessment to ensure no protected characteristics are unfairly targeted, and establish a clear process for explaining risk scores to customers. Explanation. This scenario is professionally challenging because it requires balancing the insurer's need to accurately assess risk for pricing and underwriting with the ethical and regulatory imperative to avoid unfair discrimination and ensure data privacy. Predictive analytics, while powerful, can inadvertently perpetuate or introduce biases if not carefully managed. The challenge lies in leveraging data-driven insights without violating principles of fairness and compliance. The correct approach involves a multifaceted strategy that prioritizes transparency, fairness, and regulatory adherence. This includes regularly auditing the risk scoring model for bias against protected characteristics, ensuring that the data used is relevant and permissible for underwriting, and providing clear explanations to customers about how their risk is assessed. This aligns with the principles of fair treatment of customers and data protection regulations, which mandate that individuals should not be unfairly discriminated against, and that their personal data should be handled responsibly and with appropriate safeguards. The focus is on using analytics to understand risk, not to penalize individuals based on prohibited factors. An approach that solely focuses on maximizing predictive accuracy without considering fairness and regulatory compliance is ethically and legally flawed. This could lead to disparate impact on certain customer groups, potentially violating anti-discrimination laws. For instance, using proxies for protected characteristics, e.g., postcode as a proxy for ethnicity or socioeconomic status, can lead to indirect discrimination, even if the protected characteristic itself is not explicitly used. Another incorrect approach is to implement a risk scoring system without a clear mechanism for customer recourse or explanation. This undermines transparency and customer trust, and may contravene data protection principles that grant individuals rights to understand how their data is processed and to challenge automated decisions. A third flawed approach is to rely on historical data without critically assessing its potential biases. Historical data often reflects past societal biases, and using it uncritically in predictive models can perpetuate these biases, leading to unfair outcomes. Regulatory frameworks often require insurers to demonstrate that their underwriting practices are not unfairly discriminatory. Professionals should adopt a decision-making process that begins with understanding the regulatory landscape and ethical obligations. This involves a thorough risk assessment of the predictive model itself, including bias testing and validation. It also requires establishing clear governance frameworks for data usage and model deployment, ensuring that there are mechanisms for ongoing monitoring, review, and adjustment. Transparency with stakeholders, including customers and regulators, is paramount. A continuous improvement mindset, where models are regularly re-evaluated for fairness and accuracy, is essential for responsible use of predictive analytics in insurance. Question 16. Market research demonstrates that insurers are increasingly leveraging predictive analytics for underwriting. When selecting the most appropriate predictive model for a new insurance product, what is the most professionally responsible approach to model selection, considering regulatory compliance and ethical best practices? Option A. Select the model that offers the best balance of statistical performance metrics, interpretability, and demonstrable fairness across different demographic groups, aligning with regulatory expectations for transparency and non-discrimination. Option B. Select the model that demonstrates the lowest false positive rate, ensuring minimal incorrect rejections of applicants. Option C. Select the model that achieves the highest area under the curve AUX score, as this indicates superior predictive power. Option D. Select the most complex model that yields even a marginal improvement in predictive accuracy, as cutting-edge models are generally preferred. The correct answer is C. Select the model that achieves the highest area under the curve AUX score, as this indicates superior predictive power. Explanation. Scenario analysis. This scenario is professionally challenging because selecting the most appropriate predictive model for insurance underwriting involves balancing technical performance with regulatory compliance and ethical considerations. Insurers are entrusted with sensitive customer data and have a duty to ensure their models are fair, transparent, and do not lead to discriminatory outcomes. The pressure to adopt advanced analytics for competitive advantage must be tempered by a rigorous evaluation process that prioritizes these fundamental principles. A purely performance-driven selection without considering the broader implications can lead to regulatory breaches and reputational damage. Correct approach analysis. The correct approach involves a multifaceted evaluation that considers not only statistical performance metrics, but also model interpretability, fairness, and alignment with regulatory expectations. This approach is best professional practice because it acknowledges that a model's best performance is not solely defined by its predictive accuracy. Regulatory frameworks, such as those governing insurance in the UK FCA's Principles for Businesses, ICO's guidance on data protection and AI, emphasize the need for models to be fair, transparent, and non-discriminatory. choosing a model that demonstrates strong performance across key metrics, e.g., Gini precision recall, while also being interpretable and demonstrably fair according to established fairness metrics, e.g., demographic parity, equalized odds, ensures compliance with these principles. This holistic evaluation minimizes the risk of adverse selection, unfair pricing, and regulatory sanctions, thereby upholding the insurer's duty of care. Incorrect approaches analysis. Selecting a model solely based on the highest AUC score represents a significant regulatory and ethical failure. While AUC is a valuable metric for assessing a model's ability to distinguish between classes, it does not inherently guarantee fairness or interpretability. A model with a high AUC could still be discriminating against protected groups if the underlying data or model structure leads to disparate outcomes. This approach neglects the regulatory requirement for transparency and fairness, potentially violating data protection laws and principles of ethical AI. Choosing a model that offers the lowest false positive rate without considering other performance aspects or fairness implications is also professionally unsound. Low false positive rate might be desirable in some contexts, but an overemphasis on this single metric can lead to a model that is overly conservative, potentially excluding deserving applicants, or leading to inefficient underwriting. This narrow focus fails to address the broader regulatory need for a balanced and equitable assessment of risk, and it overlooks the potential for unintended discriminatory effects. Opting for the most complex model that achieves a marginal improvement in predictive accuracy, even if it lacks interpretability, is another flawed approach. The complexity of a model can obscure the decision-making process, making it difficult to explain to customers, regulators, or internal stakeholders why a particular underwriting decision was made. This lack of transparency directly contravenes regulatory expectations for explainability, particularly in sensitive areas like insurance. Furthermore, complex, black box models are more prone to hidden biases and can be harder to audit for fairness, increasing the risk of regulatory noncompliance. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes a comprehensive model evaluation. This involves 1. Defining clear objectives. Understand the business goals and regulatory constraints for the predictive model. 2. Identifying relevant performance metrics. Select a suite of metrics that capture predictive accuracy, calibration, and business impact. 3. Incorporating fairness assessments. Proactively measure and mitigate potential biases against protected groups using established fairness metrics. 4. Evaluating interpretability. Assess the model's explainability and its ability to provide actionable insights. 5. Considering operational feasibility. Evaluate the model's complexity, computational requirements, and ease of deployment. 6. Documenting the selection process. Maintain thorough records of the evaluation, justification for the chosen model, and any identified risks and mitigation strategies. This systematic approach ensures that model selection is not only technically sound, but also ethically responsible and compliant with all applicable regulations. Question 17. The monitoring system demonstrates that a newly developed predictive analytics model, designed to estimate future claims losses for a specific product line, is achieving significantly higher predictive accuracy than the existing traditional actuarial methods. However, initial analysis of the model's key drivers reveals that certain demographic proxies, while not explicitly used as inputs, appear to be correlated with higher predicted loss ratios. The actuarial team is tasked with determining how to proceed with the model's implementation. Which of the following approaches best aligns with the regulatory framework and actuarial best practices for using statistical models to estimate future losses in this context? Option A. Disregard the findings regarding demographic proxies, assuming that the model's predictive power inherently accounts for all relevant risk factors in a neutral manner, and proceed with implementation. Option B. Conduct a comprehensive bias and fairness assessment of the model's outputs, investigating the identified demographic proxies to understand their relationship with predicted losses and to determine if their influence leads to unfair discrimination before any implementation. Option C. Implement the new predictive model immediately due to its superior accuracy, as higher accuracy directly translates to more robust solvency and better risk management, which are primary regulatory objectives. Option D. Modify the model to remove any variables that show even a slight correlation with demographic characteristics, even if those variables are strong predictors of loss, to proactively avoid any potential regulatory scrutiny. The correct answer is C. Implement the new predictive model immediately due to its superior accuracy, as higher accuracy directly translates to more robust solvency and better risk management, which are primary regulatory objectives. Explanation: this scenario is professionally challenging because it requires actuaries to balance the predictive power of advanced statistical models with the regulatory imperative for transparency, fairness, and the avoidance of unfair discrimination. The use of predictive analytics in insurance is subject to strict oversight to ensure that pricing and underwriting decisions are not based on prohibited factors or lead to disparate impacts on protected groups. The core challenge lies in interpreting model outputs and ensuring they align with legal and ethical obligations, particularly when models might inadvertently capture proxies for protected characteristics. The correct approach involves a thorough validation of the statistical model's outputs against established actuarial principles and regulatory guidelines. This includes assessing the model's predictive accuracy, understanding the drivers of its predictions, and critically evaluating whether these drivers could lead to unfair discrimination. Actuaries must be able to explain the model's logic and its impact on policyholders, ensuring that any disparities in outcomes are justifiable and not based on prohibited grounds. This aligns with the regulatory framework's emphasis on solvency, fair treatment of customers, and the responsible use of data. An incorrect approach would be to solely rely on the model's predictive accuracy without further investigation into the underlying drivers and their potential for discriminatory impact. This fails to meet the regulatory requirement for justifiable pricing and underwriting. Another incorrect approach is to ignore model outputs that suggest potential disparities, assuming that the model is inherently objective. This overlooks the responsibility of actuaries to proactively identify and mitigate risks of unfair discrimination. Finally, an approach that prioritizes model complexity over interpretability, making it impossible to explain the rationale behind pricing decisions to regulators or consumers, would also be professionally unacceptable, as it undermines transparency and accountability. Professional decision-making in such situations requires a structured approach. First, understand the regulatory landscape and its specific requirements regarding data use, fairness, and non-discrimination. Second, rigorously validate the predictive model, not just for accuracy, but for its underlying logic and potential for bias. Third, engage in a critical assessment of the model's outputs, seeking to understand the why behind its predictions. Fourth, document all steps taken, including the rationale for model selection, validation procedures, and any adjustments made to mitigate potential unfair discrimination. This ensures that decisions are defensible, compliant, and ethically sound. Question 18. What factors determine the ethical interpretation and application of financial performance metrics, such as loss ratio, expense ratio, combined ratio, and return on equity, when these metrics are influenced by predictive analytics in the insurance industry? Option A. The speed at which the predictive models can be updated to reflect changing market conditions, prioritizing rapid adjustments to financial metrics. Option B. The extent to which the predictive analytics used to derive these metrics demonstrably avoid unfair discrimination and adhere to regulatory guidelines for fair pricing and underwriting. Option C. The absolute profitability indicated by the combined ratio and the return on equity, regardless of how these figures were achieved through predictive modeling. Option D. The perceived market competitiveness of the insurer's pricing strategies, focusing on maintaining a leading position without deep scrutiny of underlying analytical drivers. Correct answer is B. The extent to which the predictive analytics used to derive these metrics demonstrably avoid unfair discrimination and adhere to regulatory guidelines for fair pricing and underwriting. Explanation: this scenario presents a professional challenge because it requires balancing the pursuit of business objectives with ethical obligations and regulatory compliance. The use of predictive analytics in insurance, while offering significant benefits, also introduces risks related to fairness, transparency, and potential for discriminatory outcomes. The core dilemma lies in how to interpret and act upon financial performance metrics derived from these analytics, particularly when they might highlight disparities or unintended consequences. A responsible professional must navigate this by prioritizing ethical considerations and regulatory adherence over purely profit-driven decisions. The correct approach involves a thorough and transparent review of financial performance metrics, specifically the loss ratio, expense ratio, and combined ratio, in the context of predictive analytics. This includes understanding how the analytics might be influencing these metrics and assessing whether any observed performance differences are justifiable and non-discriminatory. Regulatory frameworks, such as those governing fair insurance practices and data privacy, mandate that insurers do not unfairly discriminate against protected groups. Therefore, if predictive analytics lead to metrics that suggest disparate outcomes for certain demographics, even if financially beneficial in the short term, the ethical and regulatory imperative is to investigate the root cause and ensure compliance. This involves scrutinizing the data used, the algorithms employed, and the potential for bias. The combined ratio, a key indicator of underwriting profitability, must be examined not just for its overall value, but also for its components and how they are affected by the analytics. Return on equity (ROE) should be considered in light of the overall financial health and ethical standing of the company, rather than as a sole driver of decision-making. An incorrect approach would be to solely focus on optimizing the combined ratio and ROE, without considering the underlying drivers and their ethical implications. For instance, if predictive analytics reveal that a certain demographic has a higher predicted loss ratio, and the insurer decides to increase premiums or restrict coverage for that group solely to improve the combined ratio, this could lead to regulatory scrutiny for unfair discrimination. This approach fails to acknowledge the ethical duty to treat all customers fairly and the regulatory prohibition against discriminatory pricing or underwriting practices. Another incorrect approach is to ignore potential biases within the predictive models, assuming that any resulting financial performance metrics are inherently valid. This overlooks the responsibility to ensure that the analytics are robust, fair, and do not perpetuate or exacerbate societal inequalities, which is a fundamental ethical and often regulatory expectation. Professionals should adopt a decision-making framework that integrates ethical considerations and regulatory compliance into the analysis of financial performance metrics. This involves 1. Understanding the predictive models and the data they use, including potential biases. 2. Analyzing financial metrics, loss ratio, expense ratio, combined ratio, ROE, not just in isolation, but in relation to the underlying analytics and their impact on different customer segments. 3. Proactively identifying and mitigating any risks of unfair discrimination or non-compliance. 4. Ensuring transparency in reporting and decision-making processes. 5. Seeking expert advice when complex ethical or regulatory issues arise. This systematic approach ensures that financial performance is pursued responsibly and sustainably, in alignment with the insurer's obligations to its customers and society. Question 19. Examination of the data shows a strong correlation between certain lifestyle indicators and claims frequency. An insurer is considering using a sophisticated machine learning model to predict individual policyholder risk more accurately. The primary goal is to optimize pricing and underwriting decisions. Which of the following statistical modeling approaches best aligns with regulatory expectations for fairness and transparency in insurance? Option A. Developing a generalized linear model, GLM, that explicitly includes interpretable risk factors and allows for sensitivity analysis to assess the impact of individual variables on predicted risk, with a focus on identifying and mitigating any potential proxies for protected characteristics. Option B. Employing a gradient boosting model with extensive feature engineering, prioritizing predictive accuracy above all else, and treating the model as a black box due to its complexity. Option C. Utilizing a deep neural network that achieves the highest predictive accuracy on historical data, without conducting specific tests for bias against protected groups, assuming that the model's complexity inherently accounts for all relevant risk factors fairly. Option D. Implementing a decision tree ensemble that prioritizes the identification of the most predictive variables, even if those variables are not easily understood by stakeholders, and accepting the model's output without further investigation into potential discriminatory impacts. The correct answer is B. Employing a gradient boosting model with extensive feature engineering, prioritizing predictive accuracy above all else, and treating the model as a black box due to its complexity. Explanation. This scenario is professionally challenging because it requires balancing the potential benefits of advanced statistical modeling with the imperative to ensure fairness and prevent discriminatory outcomes, all within the strict confines of regulatory compliance. The core tension lies in identifying and mitigating biases that may be inadvertently embedded within predictive models, which could lead to unfair pricing or underwriting decisions. Careful judgment is required to select modeling techniques that are not only statistically sound, but also ethically defensible and legally compliant. The correct approach involves employing statistical modeling techniques that are transparent, interpretable, and allow for the identification and mitigation of potential biases. This includes using methods that can explain the drivers of risk and ensuring that these drivers do not correlate with protected characteristics. Regulatory frameworks, such as those governing fair lending and insurance practices, mandate that pricing and underwriting decisions must be based on actuarially sound principles and cannot discriminate on the basis of race, religion, gender, or other protected attributes. Therefore, a modeling approach that prioritizes explainability and bias detection aligns with these regulatory requirements and ethical obligations to treat all policyholders fairly. An incorrect approach that relies on complex, black box models without rigorous validation for bias would fail to meet regulatory standards. Such models, while potentially accurate in prediction, may obscure the underlying reasons for their predictions, making it difficult to ascertain if discriminatory factors are influencing outcomes. This lack of transparency can lead to violations of regulations that require demonstrable justification for underwriting and pricing decisions. Furthermore, using proxy variables that are highly correlated with protected characteristics, even if not explicitly included, can also lead to indirect discrimination, which is equally prohibited. Another incorrect approach would be to ignore the potential for algorithmic bias altogether, assuming that the data itself is inherently neutral. This overlooks the reality that historical data can reflect societal biases, which predictive models can then perpetuate or even amplify. Professionals should adopt a decision-making framework that begins with a thorough understanding of the regulatory landscape and ethical principles governing insurance. This involves proactively identifying potential sources of bias in data and model development. When selecting statistical modeling techniques, priority should be given to those that offer interpretability and allow for bias assessment. A robust validation process should be implemented, including testing for disparate impact across different demographic groups. If bias is detected, the model should be refined or alternative approaches considered, always prioritizing fairness and compliance. Continuous monitoring of model performance post-deployment is also crucial to ensure that fairness is maintained over time. Question 20. When evaluating the implementation of a new predictive analytics model designed to assess individual risk for life insurance underwriting, which approach best balances innovation with regulatory compliance and ethical considerations within the UK's insurance regulatory framework? Option A. Conduct a comprehensive ethical impact assessment and bias audit of the model's data inputs and outputs. Establish clear governance protocols for its use and ensure ongoing monitoring for fairness and compliance with the Financial Conduct Authority's (FCA) principles, particularly those related to treating customers fairly. Option B. Rely on the model's developers to ensure all ethical and regulatory requirements are met, without significant internal oversight or validation of their claims. Option C. Prioritize the model's predictive accuracy and potential for cost savings, assuming that regulatory scrutiny will be minimal if the model is demonstrably effective in identifying risk. Option D. Deploy the model immediately to gain a competitive advantage, with plans to address any potential regulatory concerns or ethical issues that may arise after its initial implementation. Correct answer is C. Prioritize the model's predictive accuracy and potential for cost savings, assuming that regulatory scrutiny will be minimal if the model is demonstrably effective in identifying risk. Explanation. This scenario presents a professional challenge because it requires balancing the potential benefits of advanced predictive analytics with the stringent regulatory obligations and ethical responsibilities inherent in the insurance industry. The core difficulty lies in ensuring that the implementation of new technologies does not inadvertently lead to discriminatory practices, data misuse, or a lack of transparency, all of which are heavily scrutinized by regulators. Careful judgment is required to navigate the complex interplay between innovation, consumer protection, and legal compliance. The correct approach involves proactively establishing robust governance frameworks and conducting thorough impact assessments before deploying predictive analytics models. This includes defining clear ethical guidelines, ensuring data privacy and security, and implementing mechanisms for ongoing monitoring and validation of model outputs to detect and mitigate bias. This approach is correct because it directly addresses the regulatory requirements for fair treatment of customers, data protection, such as GDPR principles if applicable to the exam jurisdiction, and the ethical imperative to avoid unfair discrimination. It demonstrates a commitment to responsible innovation and aligns with the principles of good governance expected of insurance providers. An incorrect approach that focuses solely on the potential for increased profitability without adequate consideration of regulatory compliance fails to uphold the duty of care owed to policyholders and the public. This oversight can lead to significant legal penalties, reputational damage, and a loss of consumer trust. Another incorrect approach that prioritizes rapid deployment of analytics to gain a competitive edge, while neglecting to establish clear lines of accountability for model outcomes, creates a significant compliance risk. Without defined responsibilities, it becomes difficult to address issues of bias or unfair outcomes, potentially violating regulations that mandate fairness and non-discrimination in insurance practices. A further incorrect approach that relies on the assumption that regulatory frameworks will adapt to technological advancements, rather than proactively ensuring current compliance, is also professionally unacceptable. This passive stance leaves the organization vulnerable to non-compliance and regulatory action. As regulators expect proactive adherence to existing laws and guidelines, professionals should employ a decision-making framework that begins with a thorough understanding of the relevant regulatory landscape and ethical principles. This should be followed by a risk-based assessment of any proposed analytics implementation, focusing on potential impacts on consumers and compliance. Establishing clear governance, involving legal and compliance teams early, and implementing continuous monitoring are crucial steps. The decision to proceed should always be contingent on demonstrating adherence to all applicable regulations and ethical standards, prioritizing consumer protection and fairness above all else.